Chapter 2. We're going to deep dive now into banks, credit unions, and fintechs. So this first section covers the types of banks that there are in the US. What's interesting about the banking industry specifically is that in the US, the top 6 institutions make up nearly half of the total banking assets in the United States, while thousands share the rest. So you can see on this chart here that there is a giant gap between the Chases, the Bank of America, the Wells of the world, and some of the smaller sized community banks and credit unions that exist as well. So it's interesting because a large amount of the assets of the US are controlled by a very few handful. So when you look at this across kind of the banking spectrum, you've got the supranational banks that control most of the assets. Then you have national to regional and community. And so the supranational is the Chases and the Wells Fargo. What's interesting is that the average asset size of those institutions is about $2.2 trillion, while some of the community banks that Adrenaline's client base serves is typically around the community or regional banks, which can be anywhere from 190 million in assets to maybe 6 to 10 billion in assets. So there's a pretty wide disparity here. And what's interesting about the industry as a whole is that a lot of them are, a lot of the smaller guys who have to grow in order to survive are beginning to merge together, as they're finding that mergers is kind of the only way to gain deposit share for certain sized organizations. And if they're going to survive, then you'll see a lot of those mergers start to happen within the regional and community levels. So we're going to talk a little bit about banking organizations overall. So what you can see here is that there's a number of banking organizations. However, this slide just kind of highlights some of the ones that we interact with and the ones that you guys should be aware of. Icba is a national trade association that's exclusively dedicated to protecting the rights and serving the interests of community banks across the country. These guys do lobbying in Washington for community banks. They hold education conferences. They have certifications and training for bankers. And they typically have more of the community bank feel. So this is going to be kind of that middle to small market on that banking spectrum. The Icba is also a great marketing tool for us because Adrenaline is able to speak at some of these conferences and share thought leadership through this trade association. And the Icba is also a client of ours. So we're doing some work to help with their branding as well. The ABA is the American Bankers Association, and this is one of the largest banking trade associations that also represents banks in Washington as well. So they do lobbying as well. But they also have marketing conferences and publications for bankers to learn as well. So we actually just did a speaking conference or a speaking event at the ABA, and it's something we typically do every year because we want to reach that community banker level. The other couple of organizations on this slide is more federal funded. So this is the FDIC and the SBA. So the FDIC is the Federal Deposit Insurance Corporation. So you guys may have heard of this as well, but it's the regulating body of the banks, and it was put in place in 1933, and it's focused on preventing a run on the banks. Right. So they want to make sure that the banks are stable and in a good position to continue to operate. And the SBA is a federal agency that's dedicated to small businesses and provides counseling and capital and contracting expertise. And it's also kind of been a lot in the news recently as they helped out a lot during the pandemic, offering SBA small business loans to organizations so that they could stay afloat and help the U.S. economy throughout the pandemic. So just a little bit of a recap about banks. One thing that's interesting is that banks actually hate credit unions. So why do banks hate credit unions? It's because they don't pay taxes. And if they don't pay taxes, then they can offer more competitive rates than a bank can, which can significantly impact their ability to steal customers from them. And so that's just something that, as a general awareness, it's good to know when talking to our clients. Adrenaline often participates in marketing events put on by Icba and ABA, as I mentioned, and the governing body of the banks is the Fdic. So now we're going to do a little deeper dive into the credit union world. So we're going to start with the types of credit unions. So as I mentioned before, credit unions are a little different. They are not-for-profit. These are organizations that have different charter types. And so there are credit unions that are a closed charter, and there are credit unions that are an open or community charter. So when we talk about a credit union that's a closed charter, what that means is that they are only available you can only become a member or eligible to be a member if you are a part of a SEG group. And SEG stands for Select Employer Group. So this means that they are actually not available to be a financial institution unless you're maybe employed by a certain group or a certain company. This is closed charter. It means that it's not open to the general public. And so if you think about, for example, Emory Alliance Credit Union is a credit union here in Atlanta, and they service only those employees or those associated with Emory University or Emory Healthcare. And so as a credit union that only serves a certain employer group, if that credit union wants to grow, the way that they can grow is by offering those services to additional SEGs or by adding more SEGs to their membership base. And so now Emory Alliance has now added more SEGs that offer education services and things like that. So they have certain schools that are a part of that SEG group now. So if you want to be a member of that credit union, then typically you have to either be related to someone who's already a member or work at that particular SEG or Select Employer Group. The open and community charter credit unions are actually those that serve a certain community, but there are still requirements to be a member. So for example, you might have to actually live, worship, or go to school in a certain county, for example. This is a community charter, and so sometimes actually a credit union will migrate their charter from a closed charter or SEG group to an open or community charter. And Delta Community. So Delta Community Credit Union used to actually serve only those who were employed at Delta Airlines, but they decided to change their charter and open it up to the community. They still kept the name Delta in their name to honor the heritage that they came from, but they added the word community so that they could indicate to all of Atlanta and those who live or worship in Atlanta that they could actually become members of that credit union. So the community charters are governed by the Ncua, and bankers as credit unions try to expand their field of membership. So sometimes they'll actually try to add additional communities so that they can grow or acquire new members through community growth. One thing to note is that credit unions have a choice between a state versus a federal charter. And what is a charter? A charter is a license to operate. So a credit union can decide if they want to have a state charter or a federal charter. And there are pros and cons to both. So under a state charter, This is actually governed by state laws and regulations. And the state regulatory authorities have much greater familiarity with the local credit unions, and credit unions have accessibility to the SSA and can better affect CU policy when they're under that state charter. This can also allow for a mix and match of field of membership within the communities or seg groups that they're targeting, and it sometimes permits a more rapid field of membership expansion than a federal charter because of that flexibility of the local law or local regulations. But there can be some limitations on interest rates that could make things less appealing to them, and some of them may have to pay state income tax. So most of the time, credit unions don't have to pay taxes, which gives them that advantage over the bank. But there are some states that actually do require state income tax. There are also some states, like I believe Wyoming, that doesn't offer a state charter at all. And so any credit unions that exist in Wyoming actually have federal charters. So federal charters are really governed by the NCUA. So from a federal perspective, FCUs, which means Federal Credit Union, that have federal charters, federal insurance on member share accounts, and so they do have insurance that's backed by the government. So that's one of the advantages of a federal charter. And FCUs have one primary regulator, while state credit unions have state and federal. If you are a federal credit union, there's no income tax. You're free to operate branches and ATMs wherever you choose, so you're not really limited to the state boundaries. The loan interest rate ceilings is 18%, and there's not subject to state terms and conditions, which can be limiting sometimes. And the field of membership rules increasingly more flexible, especially for those who are targeting underserved communities. So for example, if you have a federal multi-common bond charter, you can actually reach most likely a larger population, or your field of membership eligibility can be much more expansive than state charters or community charters. So these charter decisions is one that a lot of our credit unions have. And the good news too is that we have some partners who can help Adrenaline, or we can refer our clients to in figuring out any type of field of membership changes or charter changes as our clients have questions for that. So let's talk a little bit about the organizations associated with credit unions. So one of the biggest ones that Adrenaline works with is CUNA. So Credit Union National Association. It's the largest trade organization representing the interest of credit unions. So they do lobby in DC for credit union interests. They do provide compliance and education and training services to credit unions. They also host an event every year called the CUNA Diamond Awards, where Adrenaline and other agencies in the market can actually submit for awards for marketing or marketing campaigns. And the good news is that Adrenaline has won several of those, and it's a highly competitive award, and so we're really honored to usually receive some of those. It's a big deal in the industry. So that's just a little bit about CUNA. The governing body and the federal regulating body of credit unions is the NCUA, National Credit Union Association. And they are also focused on preventing a run on credit unions, just like the FDIC is for the same purpose of banks. So just more good to knows about credit unions. Here's some takeaways. Credit union customers are members. FCU means Federal Credit Union. SEG stands for Select Employer Group. And also just note that it is referred to anecdotally as SEG, not SEG. Field of Membership, FOM, stands for Field of Membership. Federal governing body is the NCUA, and SSA is the State Supervisory Authority for state chartered credit unions. So now we're going to talk a little bit more and go into detail about fintechs, which is a super interesting topic because typically fintechs are organizations or companies that are maybe in startup mode. This is kind of exploding right now. They're usually a little nimbler and try to attract a younger customer base who's maybe looking for alternative ways to bank. And so when you think about a fintech, sometimes there are fintechs who compete with your bank. And then sometimes there are fintechs who actually enhance a bank's services. So this is just kind of an interesting lens to think about fintechs. So when we're thinking about fintechs from a competitive perspective, or fintechs that compete with a bank, they're generally disruptive to financial companies. They're focused on delivering a focused financial service through direct to consumer technologies. So for example, payments. Payments is the largest competitive functionality of fintechs right now. So you think about Venmo, PayPal, that's definitely competing with what the banks can offer. So what's interesting about these fintechs is that they're kind of unbundling these services that can create more specific nuanced markets. So now we have a payments market, for example, or fintechs that do similar payment type of functionality. So another direct to consumer technologies is Venmo, or I mentioned Venmo, Robinhood, Kickstarter, Patreon, GoFundMe. And so what's interesting about this is that, it can be a big concern to banks. They kind of feel threatened by that. But there are some fintechs that actually enhance what a bank is doing. And they do that because this is integration of technology into offerings by financial services companies in order to improve their use and delivery to customers. So it's good because there's technology that cuts down on operational costs for banks, and it's kind of given the rise of banking as a service model. But let's think about the fintechs that replace a bank, right? So Venmo. So this is mobile payment service. It's owned by PayPal. Account holders, no matter where they bank, can transfer funds to other people who are also using Venmo. So Rocket Mortgage is another example of a fintech that is competing with a bank. So this is, now I can actually get a mortgage on an app, right? Like that is a kind of unheard of streamlined experience that makes the home buying process much more easy, that never was easy before. Affirm is another interesting fintech. So this one actually tries to kind of cut credit card companies out of the online buying experience. So, for example, if I am trying to buy a Peloton online, Affirm will offer me a loan to purchase Peloton instead of me using my credit card to do that. So you can see on the Peloton website that they've partnered with the firm to offer simple financing made easier to buy a new expensive home exercise equipment. Whereas before, I probably would have used my credit card to purchase something like that. So that's definitely competing with a bank. Now, when we look at fintechs that actually work with my bank, these are some examples of those. So Fdic is a risk management platform that monitors account opening transactions. And what's cool about this is that it allows for banks to kind of verify accounts in a more accurate way, where otherwise they'd have to turn down accounts because they were at a certain risk level, for example. So this allows banks to securely approve more applications faster. Zell is another one. So this one actually competes with Venmo. So think of this as Venmo for your own institution, your own bank or credit union. So this is a fast, safe, and easy way to send and receive money to friends and family. And it exists on your banking app. So you may even actually see some commercials direct to consumer for Zell. And then there's Upstart. Upstart aims to make lenders such as FICO obsolete by using different data sets to determine credit worthiness. So this is a big challenger to how banks have historically been able to grant loans or assess risk with someone. And so this criteria can now include things like your employment history, your education level, et cetera, in order to be able to approve a loan. Now, there are certain fintechs that have a certain angle to them. These are a couple of fintechs that are do-gooders, or ones that try to help the world in some way. So Tala is one of those, and this offers consumers in the developing world microloans by doing deep data dig on the smartphones for such transaction histories. And this is actually a better way for them to, it provides consumers better options than local banks, right? So it's unregulated lenders, but it allows microfinance solutions. And so there may be more trust in Atala versus some of the local banks in developing countries. Aspiration is another one. This is a challenger bank. It's an online bank that plants a tree with every transaction that you make on your credit card or your checking account. So they won't lend out money. What's also interesting about Aspiration is that they don't lend out their money to big oil companies or fossil fuels. So those money programs go towards sustainable efforts. So a lot of the big banks will actually fund a lot of the big oil companies. So this is just a specific angle that this particular fintech is making as an alternative way to bank. And so there are some advantages to that. A bank that has leveraged financial technology to create online only offering. So there are some challenger banks like GoBank, Simple, and Chime. And this is an interesting phenomenon that's kind of happening because historically we've noticed that a physical presence is super important in the consideration set of how a person may choose a financial institution. But these online only banks are really challenging that because it's eliminating the branch network, which allows these institutions to run leaner costs because they don't have, the expense of an actual physical bank branch. And so because of that, they can offer more compelling rates and sign-up bonuses to attract new depositors. And because they're online only, they can easily enter new markets without a large financial investment, like building a branch. And they often process transactions through a partner bank. But there are still some studies out there that show that consumers may not be very comfortable using those for some reason, and that there's a trust factor associated with having a physical presence inside a market. But that is kind of starting to change over the years. And what's also interesting is that some banks are actually the backer of these online banks that's kind of hidden and behind the scenes because you have to have a charter in order to be a bank. And so that just may not be the face, though, of the bank to the customer. It's like a different brand, even though they're backed by maybe a more traditional community bank. So just something interesting to know about fintechs. So good to knows. Some traditional banks are threatened by fintech because they're so disruptive and competitive, but some traditional banks embrace the innovators and want to partner with them. A good example of that is Incredible Bank, and actually we have a podcast out on the Believe in Banking app, the Believe in Banking website that Adrenaline puts on, where we have the CEO of Incredible Bank talking about how he's embracing innovation and technology to better serve their customers. And he's a traditional community banker with physical network. So it's a really interesting podcast. I encourage you guys to check that out, as well as other content on the Believe in Banking website and podcast. And so some fintechs specifically aim to partner with traditional FIs.